If you traded stocks based on information you got at work before anyone else knew about it, you'd go to prison. That's insider trading. It's illegal. The Securities and Exchange Commission hunts people down for it. Hedge fund managers have done years in federal prison for exactly this. But there's one group of people in America who can do it legally. And when they finally passed a law to stop it, they set the fine at $200 flat. In this video, I will explain how Congress wrote a law to look like it was fixing the problem, while making sure the problem would never actually be fixed. Before 2012, there was a dirty secret sitting in plain sight in Washington. Members of Congress, the people who write the laws that move markets, who sit in classified briefings about the economy, who know about government contracts before they're announced, had zero rules stopping them from trading stocks based on that information. A senator could walk out of a classified briefing about a pharmaceutical company's drug approval, call their broker, buy $1 million in stock, and pocket the gains when the news went public. And it was completely legal. It wasn't even a gray area. Congress had quietly made sure the insider trading laws that applied to everyone else simply didn't apply to them. Then, in 2011, a CBS 60 Minutes investigation exposed this to the public. The backlash was immediate. Millions of Americans were furious. So Congress did what Congress does when it gets caught. It passed a law, the Stop Trading on Congressional Knowledge Act, the Stock Act, signed in 2012 with fanfare and press conferences and speeches about accountability and public trust.
And everybody plays by the same set of rules.
The problem was fixed, they said, but it wasn't. Here's how the Stock Act actually works. Members of Congress have to disclose any stock trade over $1,000 within 45 days of making it. That's the rule. Miss the deadline, and you pay a fine. That fine is $200. And before you think, okay, $200, that's not nothing. Understand who we're talking about. The average net worth of a member of Congress is over $1 million. Many are worth tens of millions. Some are worth hundreds of millions. For these people, $200 is not a deterrent. It's a rounding error. It's less than what some of them spend on lunch. But it gets worse. That $200 fine can be waived entirely by the House and Senate Ethics Committees, the same committees run by Congress's own colleagues, and there's no public record showing whether fines, when issued, are even collected. So in practice, the penalty for filing late is nothing, and the penalty for insider trading itself? Since the Stock Act passed, not a single member of Congress has ever been prosecuted under it, despite, as we're about to see, some remarkably convenient timing on some remarkably large trades. Let's talk about that 45-day disclosure window, because it's the other half of why this law is essentially meaningless. A member of Congress attends a classified briefing on Monday. They hear something that will move a stock price, a contract award, a regulatory decision, an intelligence assessment. They call their broker on Tuesday and make a trade. You won't find out about it for up to 45 days. By then, the stock has already moved. The money has already been made. The trade is done, disclosed, and completely legal. The only transparency the Stock Act provides is a look at what already happened, long after it was too late to matter. And then, 1 year after the Stock Act passed, Congress made it even harder to track. In 2013, Congress quietly amended the law to remove the requirement for a searchable online database of financial disclosures. This amendment passed with virtually no debate, no media coverage, and no recorded vote. The filings still exist, but they're split across two separate databases, reported in vague dollar ranges, and nearly impossible to analyze at scale without dedicated software. In other words, Congress looked like it was being transparent, and then made it harder to see what they were doing. Now, let's look at a specific example, because this is where it stops being abstract. In early 2024, Congress was debating the TikTok ban. The argument was national security. TikTok is owned by a Chinese company, it could be used to harvest American data, it poses a threat. Maybe that's true, maybe it isn't. That's a separate debate, but here's what we can look at objectively. If TikTok gets banned or forced to sell, who benefits? Its competitors, Meta, Google, Snap, Microsoft. The companies that would absorb TikTok's 150 million American users and their advertising dollars. And when researchers looked at the financial disclosures of the 352 members of the House who voted yes on the TikTok ban, they found that 44 of them owned stock in exactly those companies. The total value of those holdings? Somewhere between $29 million and $126 million. Nancy Pelosi alone, one of the most active stock traders in Congress, disclosed between $15 million and $76 million in tech investments. She voted yes. Now, is this proof that those 44 members voted to ban TikTok because it would make their portfolios go up? No. We can't prove that. And that's precisely the problem, because we can't prove it either way. The system is designed so that you never can. And as Jon Stewart put it,
Now, you might be wondering to yourself, how does Congress get away with all this? Well, it may be because Congress is regulated by, let me check my notes, Congress!
Your representatives voted on a law. Those same representatives own stock in the companies that would profit from that law. And there is no mechanism, none, to determine whether those two facts are connected. Here's one more layer that most people don't know about. The Stock Act covers spouses. Technically, a member of Congress's husband or wife also has to disclose their trades, but there's no mechanism to prove that a member of Congress told their spouse to make a trade. The spouse makes a trade, discloses it, and that's the end of it. This has a name. Researchers and watchdogs call it the spouse loophole. In April 2020, the wife of Representative Mike Kelly bought $23,075 worth of stock in Cleveland Cliffs, a steel company in Kelly's own district. The purchase came one day after Kelly privately learned the government would launch an investigation that would directly benefit the company. The public didn't find out for another 6 days. She later sold the shares for $87,551, a profit of $64,476. The Ethics Committee investigated and found nothing conclusive, partly because she refused to cooperate. Guess what? Nothing else happened. 86% of Americans support banning members of Congress from trading individual stocks entirely. Republicans, Democrats, Independents. One of the highest levels of bipartisan agreement on any policy issue in modern American history. And it's not hard to see why. Members of Congress don't just enter office wealthy, they leave wealthier at a rate that outpaces even the top earners in the country. Between 2004 and 2014, the average congressional net worth grew at nearly 7 times the rate of the wealthiest 5% of Americans. At least 25 formal proposals to ban congressional stock trading have been written up and submitted for consideration in recent years alone. For any of them to become law, a majority of Congress has to vote yes. And before that even happens, each proposal has to survive a series of internal committee reviews, where most of them quietly get shelved. In July 2024, one finally made it through that first review stage, which had never happened before. The next step was a full vote in front of the entire Senate. That vote has never been scheduled. The longer this continues, the wider the gap in both wealth and incentives gets. A Congress that profits from market movement has a financial stake in the volatility, the uncertainty, and the legislation that creates both. At some point, that stops being a side effect and starts being a feature. As for what people can actually do, what has historically moved it is sustained public attention. The Stock Act only existed because a single 60 Minutes episode made it impossible for Congress to ignore. The 2024 committee vote happened largely because the issue had been circulating online long enough to become a reputational liability. Watchdog organizations like the Campaign Legal Center and Representis track trades, violations, and failed votes publicly. Capital Trades and Quiver Quantitative turn the raw disclosure data into something anyone can read. If you like this video, consider supporting me by liking and subscribing. Thank you for watching.